all the spaces in between. It's magic when I taste you in the beam. An average day is spent all in the sheets. Emphatic when I tell you what you mean to me. Chemistry, intimate memories. Every time I give you all my energy. Emphasis, never sleep. Never sleep.
Say you have me. Oh, taste and see. Hope you don't sleep on me. I got good and plenty. I've seen all this before in my mind. All I ask is take your sweet time. Roam around and see what you find. Long as I can call it mine. Oh, I can give you everything you dream about. Let me be the one to reassure you that you'll never run out. Just say oh, taste and see. I hope you don't sleep on me. I got good and plenty, good and plenty, baby.
How did I lose you? How did I blow that? How can we go back? Why did I not choose you? Instead of a good time, I wasted your good time. I should have been everything I promised. I should have not had to learn it from this. You should have been first. I know it's emotional, but you're not emotional. She said, I should be crying, but I just can't let it show. I should be crying, but I can't stop thinking. All the things you should have said that you never said. All the things you should have done that you never did. All I said, I don't know what I should be feeling. Oh, darling, I've been stupid, thoughtless. I've been useless, heartless. I've been violating and thinking it wasn't ever gonna catch up. I wasn't ever gonna fess up, and that's real. I should have been everything I promised. I should have not had to learn it from this. You should have been first. Oh my God, I know it's emotional, but you're not emotional. She said, I should be crying, but I just can't let it show. I should be crying, but I can't stop thinking. All the things you should have said that you never said. All the things you should have done that you never did. All I said, I don't know what I should be feeling. Oh, darling, please. So I know you're feeling something, please. Cause if it hurts, I know you still care. Cause if you don't, I know you're over it. Oh, please, yeah. So that I know you're feeling something, please. Cause if it hurts, I know you still care. Cause if you don't, then I know you're over it. Oh, she said, I should be crying, but I just can't let it show. I should be crying, but I can't stop thinking. All the things you should
tainted view of us. I find it hard to see anything that was good in you and me. I hate it when you go. I'm happy when you leave. I go through withdrawals when I draw you close to me. Is this my destiny to set you free? Is this my destiny lying here with me, giving the best of me? Can't you see I got more love to share? Maybe we should stay right here in the same space. Look for different results in the same space. How we gonna look for different results in the same space? Oh, how if we're in the same space?
A million reasons why we could have said goodbye, but my heart can't deny how it feels when you're by my side. If we get any closer now, we won't have to dream the feelings that we share.
Hello, everyone. We're going to get started shortly. If you can just acknowledge in the chat that you can hear me, it would be fantastic. We're going to give everybody maybe another couple of minutes to log on, and we will start at about 5 after 10. Thank you so much, and we'll talk to you shortly. Hi. We'll be right back. Thank you. All right, guys, and we are back and ready to begin. Thank you for joining us this Saturday morning for the Crash Course on Loans. My name is Lisa Foster. I'm with AmeriFirst Financial, and shortly you will be, Mose Gatling will be joining us if she's not already online. And today we're going to be talking about loans. And loans are like one of the critical parts of home ownership. But I want to take a moment. I want to first introduce to you our moderator for today. Our moderator for today is going to be Shantae Patton. Shantae, are you on?
I am here. Hello, everyone.
All right, Shantae, we are turning it all over to you.
All right. I want to welcome everyone here to our next course. Hopefully you have been going with us this whole time and you have been learning the steps to Black homeownership. Make Homes Possible is the Las Vegas Coalition, and we came together, a group of professionals, social justice warriors, came together and said, it only takes a few people to make a difference. And we know that Black homeownership, although we did see a 1% climb in our numbers to 45.1% this week, that number is still extremely low. And to give you context, we had a higher Black homeownership rate prior to integration. And so we know that there is much to do. We also know that the only way we can gain wealth and assets within our community is through homeownership. We also know that with homeownership comes additional things, investment property, the ability to pay for college for your children. There's so many things that homeownership opens the door for us. And so that's why this coalition came together with a goal of 25,000 new Black families in homes over the next 10 years. And we are extremely passionate, but we are also very motivated, and we know that we can get this done. All it takes is one person at a time. And so we brought together the top down payment assistance companies. We got together all of the housing agencies, and we made sure that instead of individually people looking for the resources, we brought all the resources to one spot. So we are not new to this, but this is the first time that we have all collaborated in Southern Nevada to make a difference, specifically in Black homeownership. And so as a founding member of this coalition put together and backed by HOME, it includes NID, Housing Counseling Agency, which is my counseling agency. It includes Neighborhood Housing Services of Southern Nevada, Nevada Partners, NACA. There's all these different agencies. And in addition to that, we also brought in some of our lending partners, which is one of your speakers today, which is Lisa Foster, along with others. And we made sure that we could produce exactly what you needed to become a homeowner, and that is through education. So my name is Shantae Patton, and I am a housing counselor agent here. But in addition to that, I am a realtor for the last 17 years. I'm also the regional vice president of the National Association of Real Estate Brokers. That is a Black real estate organization founded in 1947. At that time, Black real estate professionals could not be members of the National Association of Realtors. And we had a battle on our hands, which is fair housing. And we knew that we had to be pivotal in order to protect our community. And one of our models is democracy in housing. So we are here, we come with a wealth of knowledge, and we know that we can make a difference. We just need you to stick with us, learn, be ready to become a homeowner, and we will walk you through that process, whether you're ready today or you're on a 3-year journey. We are here with you through that journey, regardless of how long it takes. If you have the motivation to be a homeowner, then we've got the resources and the patience to get you there. Okay, so with that, I want to first introduce Miss Lisa Foster. She is the Regional manager for AmeriFirst Financial. She is licensed in 5 different states, including here in Nevada. I call her the Loan Whisperer because she has been known to make magic happen to people who have been told no in other places. And so we are very, very happy to have her a part of this organization. I personally vouch for her. She does all of my own personal loans because I know I always need some whispering and a little magical dust thrown onto mine being a self-employed person. So she's there for that, but she also specializes in down payment assistance programs. She specializes in first-time home buyers. Not a lot of loan officers do that because that's not the sweet spot. Right? It's not the easiest and it's not the most lucrative, but Lisa is committed to that. And so we are excited to have her be one of the founding members. Also on the line here, we have Elias, and Elias is our social justice warrior backed by Homie. And Homie was the one who came and gathered us together and say, hey, we are new to this city, but we are just equally dedicated to Black homeownership. How can we help? And then we have Ella Garcia, and she's from Nevada Partners, who you know has been around for a long time. They have a huge history. They represent the culinary, but they also represent and can provide the WISH down payment assistance program, which if you're familiar, you would have heard about that last week. So, and now thank you so much. We have Mose Gatling with Loan Depot. She is also a loan whisperer and comes with a wealth of knowledge. And so between these two ladies, they've got what you need. Bring your questions. This session is for you. We know it's Saturday and there's all sorts of things you could be doing. So we appreciate the dedication that you have to just showing up and putting yourself first, right? So these ladies are here. I will be monitoring the chat. So I will be ready to go with all of your questions. I will be, if I cannot answer them, wait till the end and our ladies here will get those answered for you. But this is your time, right? So let the loan whisperers do what they do and get you what you need because they are here solely to put you in homes, whether it's Black home ownership or any other home ownership. Our goal is home ownership. Okay, so with that, we will get ourselves started. Ms. Foster, are you ready for us? You're on mute.
We are ready. Are you ready, Ms. Gatlin?
I am ready.
All right, take it over, ladies.
All right, thank you, Shantae Patton. And thank you guys again for joining us this Saturday morning. Mose is going to kick it off with the conversation of, let's talk about what a mortgage is really. And here's the thing that I need to prep you for. You know, with me, you're going to get a little Southside Chicago. With Mose, you're going to get a little Kansas City. So we are going to honestly have a real conversation about lending and home loans. So with that, Mo, take over the first slide.
Okay. Let's talk about a mortgage itself. Everybody throws around the term mortgage, but you really need to know what it is. Basically, by taking out a mortgage or applying for one, you're promising to repay this lump sum of money to a mortgage company, literally just based on your promise. Yes, the mortgage itself is secured by the property, but mortgage companies are not in the business to have people's homes. They do not set out to give you loans because the law prevents it just on the basis of being able to take it back. They just want you to pay your payments. So by taking one out and applying, the decision is made to grant you one based on you just making those payments every single month. Mortgage companies grant these mortgages, but they are backed by federal agencies. So there are a list of rules. That means, let's just say Lisa's the homie. You call her and say, Lisa, give me a mortgage. Lisa can't just say, here you go, girl, take it. Nope, there's rules. Okay, and we're going to get into some of those as we go further to talk about that. These government agencies set out everything we're supposed to follow. Sometimes exceptions can be made here and there, but the basis and the framework is laid out by them. Okay, you have to qualify. Again, that homie hookup doesn't exist when it comes to mortgages because those rules are out there. you're going to have to follow a set of guidelines. So you hear a lot of mortgage people throw around, well, guidelines say. That's why we want to incorporate, kind of break down some of this terminology, but incorporate essentially what guidelines are for you, so you know what's going to be expected of you when you go to apply, and you have all these in your toolkit to be able to be ready when you get there. Think of it this way. When you take out a mortgage, most times it's the largest borrowing of money anybody does. Nobody typically has on their credit, just say the average consumer, loans that are $250,000, or we can say $250,000. When you think about that, that's a lot of money you're borrowing. So when you get ready to do an application and things like that, and prepare, bring your A game, because it is a lot of money, and the mortgage lender and the government think so as well. So again, don't take it personally, but you're going to be asked a lot of questions and things like that, and to prove things to take out this much money. Okay. It is not a personal thing. Like I said, no homie hookups out there to be able to get a mortgage at all, but we are going to ask you questions. So be prepared, get it in your spirit that nobody is going to judge you, but we have to ask these things to be able to lend to you. And the more information you give us, the better we can actually help you, because we know where you're coming from and what you've been through in order to get to the finish line.
So I want to add on to that, Mo. I always like to say, treat me like whoever you trust with all your secrets. If you think about your family doesn't see your pay stubs, they don't see your bank statements, they don't see your W-2s. We see all of that information. And what we need you to do is, whatever lender you choose, be honest with what's going on in your life. Our job is to take the way you've been living your life and make it conform to those guidelines that Mo just spoke about. Yes. But we can't do that if you hide stuff from us and then it gets found out later and we like, oh yeah, about that. So, you want to treat us as if we are your greatest confidant. We are your ally, and you want to share all that information with us. So I want to talk a little bit about the mortgage process. Mo, you good with me taking this one?
Absolutely. Take it away, Lisa.
Right. So let's talk about what is pre-approved versus pre-qualified. And this is so critical to your success as a homeowner. Mo and I have these conversations almost daily about people who perceive that they are pre-qualified or pre-approved, and they're not. What pre-qualified means is that you have provided a lender with some information. We have taken that information and we have run it through what's called a desktop underwriter. It's a system, it's an automated system that will let us know you're approved. It does not confirm your income. It doesn't confirm anything. So it is a system that can be easily tricked. So what we want to do is we want you to actually go and get pre-approved. What does that mean? That means that you've actually completed a mortgage application. And if you can see on my screen, you can see, what happens when you do a mortgage application. You physically do a mortgage application. That's what happens. That's the first step. You physically are talking to someone. We're going to ask you a ton of questions. We're going to ask you, where have you lived for the last 2 years? Where have you worked for the last 2 years? Where are your bank accounts? What debts do you have? Do you have child support? Are you receiving child support? Is there any other income that you want to provide to us for the purposes of qualifying for a home mortgage? We're going to ask you a ton of questions. I'll give you an example. If you give me a bank statement and I see every month you're paying Toyota $556, but I see on your credit report there's no Toyota, I'm going to ask you, so why are you over there paying Toyota if you don't have a car loan?
That part.
I'm going to ask you because that's my job, not because I'm nosy, because that is actually my job. The next step is we're going to request your W-2s, your bank statements, your pay stubs. We need to verify that what you think you make is what you really make based on the way that we calculate income. And coming off of COVID, that calculation has even gotten trickier because so many people were out of work or were laid off. So, we want to make sure you're clear. We're going to gather up that information and we're actually going to send it to an underwriter. An underwriter is the person that actually has the ability to make the formal lending decision. They are the ones that are empowered by our various organizations to actually loan money on behalf of our company. Once you have that underwritten approval, that means that all of your finances, your assets, your down payment assistance program, everything has been reviewed. And the underwriter says, based on what I see today, you're mortgage ready and I would grant you a loan. That means all you have to do is go out and find your property. Now, there's a couple of caveats that Mo and I wanted to make sure that we make sure we share with you all. And in case you didn't hear, I don't call Mose, I'll call Mose Mo. In case you're wondering who Mo is Mose. You know, I want to make sure everybody understands. We're going to verify everything. Everything. If you give us a bank statement, we're going to make sure that bank statement really came from your bank. If you gave us tax returns, we're going to make sure that the tax returns you've given us are the tax returns you gave the IRS. That's all kind of important. We're going to make sure that if you work a job, I don't know that you just didn't start yesterday and they just gave you some pay stubs and W-2s and all of a sudden, voila, you were employed. We are going to go ahead and actually make sure that we do verify everything. Okay, so that's why that disclosure is so important, because it's very hard for us to go to bat for you with an underwriter, the person who makes the lending decision, and then to have them unveil something that we didn't know. At that point in time, it's very difficult to backtrack. Okay, the last thing I want to make sure that we say in this pre-approval process, and for you guys out there who are qualifying for this mortgage, if you did not tell the IRS about this money, guys, it doesn't count. So if you're a tip employee and you're only using tip compliance and you're not reporting the rest of the tips to the IRS, unfortunately, I can't use those tips to qualify. If you're a business owner, like Shantae says, she needs a little whispering. If you're self-employed and you write off all of your money, basically you tell the IRS, yes, I made $100,000, but I spent $120,000, running my business. So I actually went in the hole $20,000. That means technically you don't really have any money available to make a mortgage payment. So we want to keep all of that in mind, because sometimes the way we're living our lives, because I get it, the way we're living our lives sometimes becomes a double-edged sword when we get ready for home ownership. So with that, Mo, this is you.
Okay. All righty. Let's talk about this mortgage payment. This is very, very important, I would say, because anytime you get qualified or you're talking to a mortgage person, the way they qualify you is based on that payment. So when they figure a payment for you, you need to know what it consists of. Also, because when you see mortgage advertising, it may tell you payments starting at and give you a figure, but you need to know what to ask that person when they're advertising, because they have to tell you the amount that it takes to repay the loan and maybe not the expenses tied to the house. Okay. So a mortgage payment is based on or made up of principal and interest. When they say principal and interest, that is just the amount that it takes to pay the loan back. So if you did a 30-year term, it's literally referring to what you would pay the lender strictly for borrowing the money. But there are other things that also go into that, because on top of paying back that balance that you took from them or that amount of money you got, you pay interest, right? So you have your principal and interest put together in one figure. The interest is literally just based on how much interest you would end up paying per year, broken down on a monthly basis, included in your payment. You cannot forget property taxes. The next 2 or 3 things that I'm going to go over are the ones that sometimes can be omitted when you see mortgage advertising, because when they give you advertisements, they're giving you the cost of the money repayment, not the things that are attached to the home. So there are property taxes attached to each home that you may look at in Las Vegas. The tax value is already predetermined based on the tax rate of the house itself based on the zip code. The zip codes all in Las Vegas have a property tax value assigned, which you can actually look up on the county website under taxes if you really wanted to know the tax rate before you purchased, okay? If it's a brand new home, the tax rate that the house resides in will be estimated on the purchase price, okay? So it affects how much you can qualify for. Homeowners insurance. The mortgage lender is going to require that you have homeowners insurance on your property, okay? That homeowners insurance, it does happen to cover your personal items that are in the house if there was a loss. Say, for instance, a fire, perhaps a flood, something of that nature. So your personal things are in that house and would be covered, but it also covers the building itself, the roof, anything that would happen in case of a loss or an incident. So we require that because the home is going to be the security basis of you taking out that mortgage, okay? Kind of like a car, you have a car title, there's a home title as well that's recorded in your name. So that house is the security instrument for the mortgage itself. And there is what's called mortgage insurance. This is different from the last insurance we just talked about. The mortgage insurance itself, unfortunately, it doesn't really benefit you, but it insures the lender, okay? And the agency or the federal agency that backs the loan in case of loss, okay? So you do pay insurance called PMI if it is a conventional loan or MIP. And then depending on the house you choose, you may see gated communities around town. There could be an association dues. So again, that's based on the house that you choose. It's not a repayment of the loan itself, but the house you choose may have that cost. So when you get a full payment breakdown, it should include all of those things from your lender to tell you what the total housing expense is. Because there's a difference between what you pay the lender and what the housing expense is. So you need to know that. Again, your budget may not be what you can get qualified for. So you got to make sure you don't bite off more than you can chew, because you know what you want to do with your life and how you want to spend your money as well.
Keep going, Mo.
Okay, I was going to ask if you wanted to take over. We're going to talk a little bit about different loan types, okay? Because again, this terminology is thrown around. So we want you to understand the loan types that are out there that people may discuss with you. The first loan type I'll talk about is FHA. FHA literally stands for Federal Housing Administration, okay? It's an insurance-backed mortgage provided by FHA. It is a taxpayer-funded program, believe it or not. So to get the program going, and a lot of the rules that are established that the lenders have to use, Congress votes on to put them in effect. So that's where we said sometimes exceptions can be made, but know that the basis of it, it's a decision made way up on high that we can't necessarily change, unless Congress meets and votes on it. FHA is a more credit forgiving type of loan. It allows credit scores to be a little bit lower without you having to be penalized for having a little bit lower of a score, okay? Typically, lenders can go down to a 580 credit score, okay? And you can purchase with more limited credit. Say you don't have 5 full years of credit history, with FHA, that may be okay, okay? FHA really hones in and focuses on what you've done the last 2 years on your credit. So think of it that way. Not necessarily 1 year, but what you've done the last 2 years as far as repayment history, and also even your work history and things like that. Most times you have to have a 2-year work history with FHA, meaning we'll look back, we'll get your job history, make sure you worked that time. So when I say 2 years, think not over 2 years, but worked literally 24 months. So we can establish that and evidence that history. It really looks for job stability for you though, too. Making sure that you worked, gainfully employed, and maybe not, say within that 2-year period, if you had 10 jobs in 2 years, it's really looking for you to hone in and anchor down and have that steady Freddie employment, okay? It uses that traditional income verification Lisa was talking about. So remember, think of FHA, it's a government agency, so the IRS is its sister. You can't tell its IRS you make something and then come tell FHA you make something different, because it's going to be verified and FHA will say, that doesn't work, okay? We're going to go off of what you told our sister or the IRS you actually make. It requires a 3.5% down payment. That 3.5%, you literally just take the price of the house times 3.5% in order to figure out what you're going to have to come up with money in order to purchase. Okay. There are waiting periods that FHA actually has for credit events, I'll call it. Okay. If you had a bankruptcy, FHA is probably the most forgiving as far as wait period. They do make you wait 2 years before you can take out an FHA loan. They make you wait 3 years if you had a past foreclosure or a house that was late to the point of getting a foreclosure notice. And Chapter 13 has a little bit different guidelines. Sometimes they may allow you to purchase after you've paid into your Chapter 13 for quite a while, and you can evidence stability and reestablished credit. Okay. Mortgage insurance premiums are on FHA for the life of the loan. So as much as I love my customers and people that I work with, I wish I could take it off for you if you put a big down payment on it, or you've had the house for 5 years or 6 years. By taking on FHA, you are agreeing that that particular loan will have that mortgage insurance premium, and you'll see the abbreviation MIP. That's literally mortgage insurance premium, same for that life of the loan. Okay. And what's cool about FHA, because it's more credit forgiving, it treats the person with that 620 credit score exactly the same as they do the people with the 800 score when it comes to cost of the mortgage. You don't pay any higher mortgage insurance premiums because your credit's 620 instead of 800. So that's where the forgiveness kind of comes in for score. Whereas some loans strictly make the rules depending on your score. Okay.
So I'm going to start, and we're going to talk a little bit about VA loans. Do we have any veterans on with us today? Anybody who's a vet? I'm looking at the chat. All righty. So that VA loans are available for active duty veterans and survivors, and in some cases, their spouses. Some of the benefits for a VA loan is that there is no requirement for a down payment. Now, we want to make sure that as we go through this process, we educate you. When you are talking about buying a home, there's 2 different costs you need to contend with. The first one is going to be your down payment. That is the part that you have to contribute to the purchase of your home. And we're going to cover, different sources you can use. But the second is going to be closing costs. And that's the cost that it actually takes to close your home. That's the cost for your first year of homeowners insurance, for us to put your taxes in an account so that when the bill comes due, we can make payments. That's going to be your lender charges. That's going to be your home warranty. That's going to be your first year of homeowners insurance. Those are considered closing costs. So understand that veterans or people who are applying for a VA loan do not have a down payment requirement, but they do have a closing cost requirement. So that's one of the things that we want to make sure you understand, because the perception is always there's $1 down. Well, you absolutely can do $1 down. It's just more that somebody has to cover those closing costs, or we have to get a grant to cover those closing costs. There's other ways we can structure that, but the closing cost, that cost still has to be addressed. Now, one of the best things about VA loans is that there is no mortgage insurance. What does that mean? Is as Mose talked about on FHA, you have mortgage insurance premium. You do not have any mortgage insurance on a VA loan. So that's what is really fantastic about our vets who have served their country, or their spouses have served, served with them. Because, when your spouse serves, you serve as well. Is that your payment is going to be that principal, interest, taxes, and insurance. So it affords you a much more house. It gives you a lot more buying power because you do not have that monthly mortgage insurance. Now, the loan is guaranteed by the Veterans Administration, but what you do have on a VA loan is a funding fee. So depending on whether or not you're a disabled vet or not, you may have a funding fee. Now, from a credit score perspective, most lenders will go down to a 580 FICO score. So, just know that we're going to talk about credit in the next component, but just know that usually the cutoff for the majority of lenders out here are 580. That is a mid FICO score of 580. So what does that mean? Out of the three major bureaus, there's three major bureaus that we use. And anyone who's listened to me before knows that please don't say Credit Karma to me. Y'all really stressing me with this Credit Karma. We're looking at the three major credit bureaus. We're going to take the middle FICO score. Okay, that middle FICO score must be at least a 580. And if it is a 580, you can obtain a VA loan or an FHA loan. The minimum credit score for a conventional loan is going to be 620. And we want to spend a little bit of time talking about conventional loans. Number one, a conventional loan focuses heavily on your credit score and your credit history over the last 4 years. It is made for people who have been more credit responsible without a lot of credit issues, for lack of a better term. Each applicant is gauged and monitored based on their own income, their own credit profile. All of that determines your pricing, the cost of your private mortgage insurance that you have with a conventional loan. Conventional treats you individually. Remember we said that FHA treats everyone the same? Well, conventional does not. Conventional makes a difference between someone with a 700 FICO score and someone with a 620 FICO score. The loan for the person with the 620 FICO score is going to be higher, more expensive than the loan with the person for the 700 FICO score, because conventional recognizes and it rewards the higher credit scores. Now, one of the other big differences between like conventional and FHA is the private mortgage insurance does fall off as the home continues to grow in value. So when the home grows in value, the mortgage insurance actually comes off, which means that the payment actually gets reduced. So, those are some of the benefits of conventional. But I do also want to mention that conventional has extended wait periods. There's 4 years from the date of discharge for a Chapter 7, and there's 7 years from a foreclosure, or in some cases, a pre-foreclosure. So again, we want to just reiterate that conventional is really, really for the credit responsible, who have actually demonstrated that responsibility over time, over an extended period of time. Now, one of the other huge things that I want to mention. Who out there has student loan debt? Now, I can put in the chat, I got tons of student loan debt. I financed my degree. I have debt. I owe Sally Mae, and my standing joke to my children is they will be paying Sally Mae from the estate. Sally Mae will never get all of the money that they've gotten from my education. I just owe them too much. So there are, oh, LaShonda, I love you. She said, I got some student loan debt. Lord, help me, Lord. I love that. So let's talk about an important piece that hinders us from the student loan debt is student loan debt. So on a government loan, on an FHA loan, if you have student loan debt, FHA requires that we count 1% of the loan balance against you. So if, for say example, you have $100,000 in student loan debt, that means that we are calculating $1,000 payment against your debt to income ratio. That's how much debt you carry versus how much income you make. And that's for everybody. There is no exception. It doesn't matter if you're in school. It doesn't matter if your loans are in forbearance. It doesn't matter if they're deferred. If you are applying for an FHA loan, know that we have to count 1% of that student loan balance against you as a debt. Now, let me talk to you about why conventional is different in that aspect. For those of us who are in an income-based repayment plan, conventional loans will allow you to use that income-driven repayment plan. And I want to make sure you understand it has to be an income-driven repayment plan. And again, remember, we are going to verify that you are in an income-driven repayment plan. Then that's the payment that we use against you when we calculate our debt to income ratio. So if you have great credit or you have decent credit or you're willing to go in and make sure that you position yourself well and you're carrying a lot of student loan debt, the way to go is to try to qualify for a conventional loan. So I got a question here. What if you are a co-signer on a student loan debt? If you are a co-signer on a student loan debt, it's going to depend on what loan type you're qualifying for. On a conventional loan, again, you could take that person's income-based repayment plan. On a government loan, we would have to prove that the other person is making 12 months worth of payments in order to exclude that debt, as long as it's joint. Okay, so there is some wiggle room, but just know that when you co-sign something, you're ultimately responsible for it if the other person doesn't pay. So when we're looking at lending, remember, when you're asking someone for a loan, and this is something that's so important. I need you to kind of, work with me on that mindset. You're asking someone to loan you $250,000 on your promise that you're going to pay them back one payment a month for 30 years. So I want that to sink in for a moment. For 30 years. So they're going to make sure that there is no opportunity that you will not pay them. And so if you co-sign the debt, in some cases, we're going to count that debt against you. If you co-signed your child's student loans and your child is still in school and the loans are deferred and you need an FHA loan because that's what you qualify for, unfortunately, we're going to have to count that debt against you. Did that answer your question, Ms. Monique? Mose, you want to go ahead and take the next slide? Are you there, Mo?
I am here. Okay, so we're going to talk a little bit more about this mortgage insurance premium we started talking about. Again, to be clear, it doesn't personally benefit you because you're not receiving something in exchange for paying it per month. It is an insurance that actually protects the lender or the agency that's insuring the loan for the mortgage lender, okay? So for FHA loan, you pay two types. You actually pay an upfront lump sum of 1.75% of the loan amount. What happens with that? I promise you, the lender doesn't benefit. That check is going in and right back out the door to FHA, okay? It's how they keep the program going. They insure all the loans that are done. Then you pay a monthly insurance premium. If you think back to the payment breakdown I was telling you, that is part of what's included in all of your payments, regardless of loan type, except when it comes to VA. They're the only exception. So with that monthly mortgage insurance, it will be counted in your payment. I will talk about in just a moment the exception to that rule. VA funding fee. You pay a fee to do VA. I know a lot of times when people are talking about VA, they talk about $0 down or $1 down. Lisa was so correct in making sure that everybody is aware that VA does make you exempt from a down payment, but because there are two parts of purchasing a home when it comes to financial responsibility, there's down payment and there's closing costs. We're just talking about that down payment and monthly payment right now. You do have to pay those closing costs on your own, okay? So with that VA funding fee, you pay a lump sum depending on how many times you've used the program, but it is able to be financed. Both of those are able to be financed. You don't have to pay it out of pocket. It goes into your loan amount, and that's how your payment arrives based on the amount you borrow plus that mortgage insurance premium that's charged up front, or VA funding fee, okay? On VA, you just pay it one time. You do not pay a monthly mortgage insurance premium. So sometimes VA can be the lower monthly payment if you are buying at the same price point. PMI. When you hear MIP and PMI refers strictly to conventional loans. With conventional loans, like Lisa was referring, conventional loans are more based on your credit score, every facet of them. So the amount you're going to pay for PMI is based on your credit. They will charge you based on your credit. So someone with an 800 score does have a less expensive PMI than someone, say, with a 620 score in most cases, okay? Each person receives a different rate. So you have to understand that going into it. So if you tell me, hey, but my friend, I'm going to say, okay, again, everybody, we're going to be your best friend throughout this process. We're going to know more about you than most of your friends actually know. So you have to remember, unless that friend's told you all about their credit, we have no way to compare you to somebody else. On conventional loans, you can sidestep PMI altogether if you are to put 20% down payment of the amount of the purchase price of the house. So then you won't have it at all. Then you don't have to worry about the charges, or maybe even what your friend says that they're paying in PMI per month on their monthly payment. Lisa?
Okay. Oh, she gave me.
We gonna go at this together. Look.
Yeah, we're gonna tag team it.
Okay.
So you know, when Mo and I were putting this PowerPoint together, we were like, so okay, y'all, we need y'all to stay with us through this credit piece. That's why I said stay with us now. And I have a friend who always says, now listen. Hold on. When you're coming to someone and you are asking them to lend you $250,000, guys, you gotta at least appear like you care about your credit. I mean, it just kind of is what it is. You have to. Mo, help me out here so it doesn't come.
I got you. Wrong. Okay. On that, appearing you care about your credit. It's not that you don't care, but I can give you a couple of analogies that Shantae and Lisa may laugh, and we'll see Lisa silently laugh. If you, let's say over the last 5 years, you've had some things occur. Life occurred. You didn't pay people on time. You had to go back and, fix that. We're coming out of a pandemic. Because you woke up on Tuesday and decided you wanted to buy a house, and on Tuesday you go pay some people, it doesn't mean that on Wednesday or Thursday or even today, 4 days later, boom, you're ready, right? You have to have that longer term relationship, okay? The credit bureau's job is to rate your past ability to repay and give lenders a number that correlates directly with how do you care about your credit. So again, like relationships and things like that, I didn't meet you Saturday and today I'm gonna marry you necessarily because I feel you care for me so much. It's a longer term thing. So it's not that you can't buy if you've had some things happen on your credit. On some of the loan types we went over, we were saying how they look at really like the last year or the last 2 years. So if you get in there and maybe you go back and rectify some items on your credit, know that yes, everybody can purchase. You just have to get in those really good habits, because again, this loan is being given to you solely on your promise to make one payment at a time every single month. And I'm gonna add the with no fail. Okay. So your past credit history, if you took out things and then you didn't pay them and then you went back and paid them 6 months later, nope. We want one payment a month, every single month, no fail, without, well, what happened was we don't get to have those side conversations when it comes to repayment. There's no clause in any loan agreement or any credit card agreement you would ever take out that if something happens, you don't have to pay. Okay. So we are looking at your ability to make that happen, even your savings that you may have in the bank to make that happen if you were to lose your job or couldn't work for a couple of weeks or something like that.
We would rather see you save $20 or $25 a week than nothing at all. It's not always the amount of the savings, it's the preparation. Mo, we've got 2 questions. We've got Beverly with her hand raised, and then we have Daryl and Monica. So Beverly, I'm going to go ahead and unmute you. If you want to ask your question, we'll be happy to take it now. Go ahead, Beverly. Beverly, did you want to talk? No? Okay, so we do have a question in the chat, It says from Miss Portia, that applies to student loans, one payment a month. Student loans are going to be the demise of many people. Here's something that a lot of people don't understand. When you don't pay your federal student loans and you just ignore them, you know what the federal government does? The federal government puts a hold on your social security number so that you can't even get an FHA loan. So yes, you got to do something with those student loans. Defer them, get in a repayment plan. No matter how old your student loans are, trust and believe they do not ever go away. They're always going to be there. The federal government is going to always win. Be clear
The
about
same
that.
with the IRS as well. I'll add that too. The same with the IRS. They will put a hold on your social security number. We check that when you get into a contract. And let me say that again, after you're in a contract. So you may feel like, oh, I got my house. And then because you don't tell us something, look, we have to go back and try to figure things out for you. The things that you owe the government never go away. Even if you file, say, a bankruptcy or something like that, you still got to go back and pay them too. Okay. So an arrangement is key. Just don't ignore it.
Okay, I'm going to try to unmute Daryl and Monica. So we've added you so that you can actually speak. So if you guys want to unmute yourselves, I think you guys may have a question. Maybe. Okay, well, we're gonna keep going until you guys, if you have a question, guys, we're monitoring the chat. So if you have a question, feel free to go ahead and put it in the chat and we will do our best to circle back. Okay, so Lashana had, how are student loan deferments observed by lenders? Well, it depends again on what type of loan product you're getting. If you're doing conventional, the only thing that we can do is that income-based repayment plan. If you are deferred, we're counting that 1%. Same thing with FHA. If you are deferred, we're counting that 1% of the balance towards your qualifying. And we had a comment from, it looks like Lori Stevenson saying that she paid off her mom's mortgage by sending extra payments. So yes, that is always a good way to move the mortgage forward and pay it down faster and save yourself some money. So let's get back to the credit, because we want to be respectful of your time. So we want to spend a little bit of time here in the event that you have questions. When you all go through your credit report and you dispute something that you actually owe, please do understand that it doesn't just fall off your credit report, that it goes into dispute. And when you come and apply for a mortgage with Mo, myself, or anyone, we're going to have you take all of those trade lines out of dispute. So all it does is complicate the process. When a trade line is disputed, what that means is that that trade line is excluded from the FICO score calculation. So in order to get a true and accurate FICO score, we actually need to have you take it out of dispute. Does that make sense, everyone?
Can I add a comment to that, Miss Lisa?
Absolutely, girl.
Okay. Disputes. I'm gonna be I'll be the bad guy on the Zoom. Okay. What I like to call, sometimes you may have people that say, hey, I can repair your credit, give me X amount of dollars, I'll fix your credit. There's a federal law that governs it. It's called the Fair Credit Reporting Act, okay? FCRA is something you can Google. Look at it. It's a law, okay? It tells you as a consumer how and what you are allowed to dispute on your credit and how to go about getting corrections made to your report, okay? So I cannot condone nor co-sign if you go through and just say, I don't like that they're reporting on me, I'm going to dispute it. Doesn't work like that. Lisa's right. When you dispute something, it omits it from your credit score. So your credit may artificially look higher than it actually is because you're trying to dispute all these things. Trust and believe, you should dispute the items that are not reporting correctly. And when I say that, I mean, if it's something you don't really owe, dispute it. because you would be able to obtain proof that you don't really owe it. But the one thing I ask is I will ask people, why is this in dispute? If you simply don't like the dollar amount because they charged you too many fees, I'm gonna ask you to go run pay that. Because it's yours, right? Is it yours? If it's yours and you didn't pay them to zero, you owe them. You can call them and talk to them about the dollar amount, but from a legal standpoint, that Fair Credit Reporting Act, it does not give you the right to dispute it. Again, some people may advertise or say that they will repair your credit. They got to fix, you could get all these things removed. Sometimes when you dispute it, you make them investigate it. And that item that happened 6 years ago now has a new data today, and you sabotaged your credit report as well. So be careful. Look at the law. Look at what you're able to dispute from a legal standpoint, so you don't accidentally self-sabotage your credit by disputing a bankruptcy that happened 6 years ago that's close to falling off, and they redate it because you made them look into it and it drops your score. So your legit score is now lower after we've made you remove these disputes because you opened up a can of worms instead of maybe calling them and paying it. I know it does sound great. It might be what we think is the easy way out, but if you dispute it, they have the right to take it off. If the creditor doesn't respond in 30 days, it does not mean the creditor cannot re-report that if it is legitimate. So again, we're looking for the legitimacy. We want to help you, because the last thing we want you to do is we tell you, great, you can get a house because we played on the fake credit repair dark side. And then we have to update your credit, and all these things come flooding back because you've had your credit pulled again, and we see it because you thought it was gone and you invested money doing it the short way, or what we thought might be the quick way. And it doesn't help us in the long term. Okay.
So we've got a couple of questions, Mo. The first one is, do you have to pay everything off on your credit before you can buy?
I would say no, you actually don't. You do not have to pay everything off. We won't necessarily suggest that. There may be some things that we have to pay, some older collection accounts, things like that, because we're trying to establish that, again, if the past was the past, we have a new leaf over here where we're taking care of all our business. So we may ask you to pay some old things, but know if you do pay them, it may allow your credit to rehab or get better, but it might take a little bit of time. Okay. So if you go pay everything that's on your credit off today, no, you're not going to necessarily get 100 points higher. They don't give you brownie points for going and taking care of things that are 5 years old. It should have been paid on time to start with. Okay. That's a good mentality to have. They don't give you bonus points all the time for that. You won't get the higher score instantly, but it will make sure that they don't report late on you every single month and stop you from progress. Has anyone ever experienced maybe taking care of some things on credit? You thought it was going to get higher, but you felt a little defeated because it went down at first? That's natural, because again, you're taking care of old things, but in 12 months, you're looking real squeaky clean and fabulous. So don't get disheartened by that. It's just because, like I said, credit is literally rating you based on on-time payments every single month, one payment at a time. You go pay that old Verizon or Sprint bill from 3 years ago, it might lower your score slightly, but no, in 12 months, again, now all the new stuff is now reporting, so you can move on in life and not have to be beholden to the old things.
Because what we're looking for as lenders is we're looking at your willingness to pay back what you owe. I mean, that's what we're looking at. We're looking at, if you commit or you get an account, if you get an account and then you don't pay it back, and we understand life happens. So I don't want you to think that if you made one mistake or a couple of mistakes, or you went through a period of unemployment, I don't want you to think then that you can't buy. Because see, we can explain that. We can document that. But if you go and you constantly are purchasing things or creating accounts, and then you're deciding that it is more important for you to do something different than pay that bill, then that becomes an issue for a lender, because if you didn't pay them and you only owed them $300, why would I think you're going to pay me and you owe me $1,500?
Great example.
It's honestly that simple. So there's a couple of quick questions, and then we want to bring somebody up. How can you clean up your credit without a credit company? The first thing you can do is okay, Mo, Ace is talking, so go ahead and take that.
Okay. Without using a credit company, believe it or not, what I'm going to say isn't always popular. I love to do that, right? Uh, with the credit company, the federal government will actually tell you when you look up the Fair Credit Reporting Act that there's nothing that they can do that you can't on your own for free. It's kind of like if you paid somebody to maybe clean your house, there's housekeeping services out there. If you want to pay somebody to clean your house, it's not saying that you can't do it yourself. It's just, are you ready for the time it's going to take to do it? There are a few things that you can do to clean up your credit. The credit bureau loves it when you don't owe a lot on your credit cards. So one thing I'll say, be careful of as you're rebuilding credit, if you have a $300 credit limit, they only want you to owe 30% of that at most at all times. So that means, it's keeping a very low debt usage. Again, credit cards weren't really built for us to swipe and pay back something over 3 years. They were made for us to swipe and maybe pay it back in a shorter period of time, like a month or two or something of that nature. So when you have your credit cards maxed out, the credit bureau is like, uh-oh, something's up. They can't pay for it on their own. They're maxed out. So it freaks out on you and makes your credit score go down. So keeping a very low debt usage, the rule of thumb is normally 30% of the credit limit on your credit cards. It could go up. You don't need 50 credit cards to have credit. You can literally have 2 accounts on your credit. I've seen people with 2 accounts only, and because they keep the balances low and they pay them on time, they have stellar credit. That is a big misconception. So understand that when you have credit inquiries that the bureau, you're welcome, Rochelle, that the bureau considers excessive, that can also be a pain to your credit because it wants to know, why they out there looking for money. The bureau really looks at all of your habits. Think of it, all of your habits in order to give you a score. So everything you do will be factored into this report as far as your behaviors of repayment and how much debt you carry, which will affect your ability to afford this mortgage. Because if I qualify you today based on the payments you have, and then you go get more, can you still afford the mortgage that we've given? And it's such a long-term commitment in most times. Most people do take out a 30-year mortgage. That's a long time to keep control, and keep everything tethered down and not go too far outside of your affordability. So that'll basically help. Lori, I see you here in the chat. Paying things in cash is phenomenal, except for to have a credit score. Credit is your ability to pay somebody back. So if you have credit and because you're angry because you got charged a late fee and you go close all of it out, eventually you're going to have a 0 score and you're going to have a hard time getting a car or even a mortgage. So you have to pay somebody back. We never want you to go get into debt. I'm not a proponent of people being in high debt. I love my people to have low debt and definitely have cash. And I'm going to say it, in the bank, not under your mattress, but in the bank. Because when you have that cash, you can pay the things off that you have. But if you don't really want to be in debt, maybe get that one little credit card that you maybe just put gas in your car, okay? That you can go pay them back. Like I said, you don't have to have a lot of debt to establish credit, but have that thing that you pay back.
So there's another question that says, if I have 5 credit cards, should you close a couple of them? And the answer is no.
Nope.
That will definitely drop your score. The credit bureaus look at how long you've had that credit. So if you go and close those accounts, it takes that credit out of your history and can drop your score. So what I would do is just pay them down and leave them be. You can have them because all of that shows financial control. Everything that we're talking to you about today is about financial control and making sure that everyone that you know how to manage it. There's also another question that says, if you pay something off, does it fall off and does it still look like a debt or is it actually cleared? Mo, do you mind if I take this one?
Take it away, Lisa.
If you pay something off, it does go into a closed kind of paid in full status. But what does not go away and what is always red is the manner in which you paid it off. So if you paid it late, the lates just don't go away. It'll still show that you had a trade line for 36 months. And at some point in time, you went 30, 60, 90 days past due. So that history is still there, but it'll show that that account is now current, is now closed. LaShonda, do we have success stories of individuals that purchased a home and maintained payments on time and eventually paid off their mortgage? There's tons of them. There's absolutely tons of success stories. I've been doing this for 30 years. I'm a lot older than Miss Mo. Mo, how long you been in the game?
I've been doing this for, believe it or not, 24 years.
Oh, I'm not that much older than Miss Mo. But so what we do have absolute stories, but just know that most people do not keep a home for 30 years. The average homeowner owns their home for 7 years, and then they typically sell it, upgrade or downgrade depending on what's going on in their lives. They take what that equity is and they leverage it 9 times out of 10 to go get their next home. And if we have a moment, if we have enough time, we'll let Miss Patton explain to you what she just did with her home that she owned for 2 years. Yes. So I know, Shantae, we had somebody who had a question. Do you want to go ahead and bring them on up?
Absolutely. Daryl and Monica, please unmute yourself if you still have a question. If you still have a question, go ahead and put it in the chat. And then also there was a question on how do we see if they are actually.
What it was?
Oh, there you go. Welcome.
Can I hold it? You saw me to hold it.
Welcome, Daryl and Monica. Do you have a question?
Drink. Take a drink. Take a drink. Take a drink. Come here.
Oh, maybe he doesn't realize he's unmuted.
It's life.
That's life right there. So how do we see if we have actually removed or not just disputed? Where would we find that on our reports?
You are entitled to get one free report from all 3 major bureaus annually. So you can request a copy of your report annually to go through, audit, and dispute. Now, it doesn't provide your scores. If you want your scores, you do have to pay for that. But a free report, you can, what is it, annualreport.com, Mo?
Annualcreditreport.com.
Correct. So you can actually get a copy of your report and go through it. You know, and you can actually see, did you dispute it? Was it resolved? You know, all of that information. I do want to just circle back, and we're going to wrap up with credit. But I want to mention that there are a couple of credit building tools out there that you can use. Mo, I know you use them with quite a few of your clients. Do you want to share a couple?
There's a couple of options depending on maybe your technology usage level. If you want to build credit, again, we don't like you to go out and get into debt. However, self.inc, they used to be called Self-Lender. Okay. And what they do is they allow you to take out a loan. I tell everybody, don't be a hero and take the highest monthly payment, because they do let you choose the monthly payment you want to make. For instance, $25 a month. And over 2 years, maybe repay that. It's kind of cool because at the end, you're going to have money in a certificate of deposit that you walk away with because you took the time to pay them every single month. It's a great way to be able to establish credit without being the risk of being declined, because they will approve everybody as long as you haven't not paid them before in the past. So you're able to do that by going online. They have you send in your driver's license, and they take the account out for you without you having to do much of anything. It's a great way for, I had my daughter use it when she turned 18 to be able to establish credit. And by the time she turned 22, she was able to purchase a home herself because she did that. You can also take out share secured loans at your local credit union if you happen to bank with a credit union. Okay. Again, the reason why we are telling you these specific avenues are because these are the people that won't necessarily have you apply and then have a very high risk of still being able to be declined based on your credit score. Okay. So again, if it's you have a credit union relationship or we're looking for one, you are able to literally go to that credit union and ask them what they have to help you build credit. Sometimes they'll give you a credit card as well. And when we're talking about secured, with the ones that you get at your credit union, you can get those up front. If you get a secured credit card, you are the one that puts up the money for the deposit. So again, it just depends on which is easier. Self.inc, you could walk out today and you don't have to give them $500 in order to make that $25 a month payment to build credit. So those are some quick and easy ways. Did you have any others, Lisa?
No, those are really the big ones that I look at. We do have a question. Is it better to pay your cards down slowly instead of them paying off monthly, but not too slow, right? Well, there's a little caveat. A lot of people pay their cards off monthly, but because of the timing in which they pay them off, it reports to the credit bureau that you have a balance. So if you're going to pay your credit cards off monthly, then you got to make sure you're paying your credit cards up monthly before the balance due date, before the bill is due. Otherwise, you're rolling a balance and that's hurting your credit. Does that make sense, guys? So if your payment is due on the 10th, but you don't pay it off until the 20th, when the credit card company reports on the 10th, it's reporting a balance. So you don't get the benefit of being responsible and paying it off per se, from the algorithm. Mo, you want to add to that?
I agree with Lisa. There is a timing to it. You have to know that creditors report most monthly, okay, when it comes to mortgage scores specifically. That I might have just opened up a black hole here about mortgage scores versus regular scores. But for mortgage scoring, it's different than Credit Karma, like Lisa said. That's not what the scores we use. The FICO has established scoring methods for different things you may borrow for: credit cards, cars, and mortgages. So for mortgages, if you pay something off today is May 1st. Know that you may not come to me next week and I see that you paid it off.
Right.
Okay. It's not instantaneous. Creditors report one time a month based on what you did the month prior. So from April 1st to April 30th, what happened? That should show up on your credit bureau typically between the 10th and 15th of the month. Okay. I won't see what you do today until June. So that's why you may hear from people that it takes 30 to 45 days for your credit to update when you do something. It's because it's not necessarily instantaneous. When that bill is due and they give you a new statement, that's what they reported to the credit bureau. They're not going to do it in between for you instantly and things like that. It's once a month. That's why you'll see those credit updates come through or notifications.
Absolutely. So we want to be respectful of your time, and it's already 11:13. So we're going to move on into down payment and reserves.
Lisa, just a minute. We have some hands up, and I would assume that they're on the credit subject. So is it okay if we call on them before we move to the next slide?
Absolutely.
Absolutely.
Cassandra, please unmute yourself. You are up. Cassandra. Okay, if you still have a question, go ahead and put it in the chat and we will get that answered for you. And then Daryl.
Go ahead, Shante.
Daryl and Monica. Okay, if you still do have a question, please put it in the chat.
So Lori has a question. If you pay something off, get a letter from the company that the bill is paid in full. Absolutely. Let me just, is that Daryl? I'm not sure. Anytime that you pay a debt off, you want to get some type of verification that it's paid. Some of your older collection accounts, let's talk a quick moment about the difference between a paid in full and a deletion letter. When someone says, I'll give you a deletion letter, what they're giving you is a letter that basically says they're going to take it off your credit like it never happened, like it never existed. So they're going to actually remove that whole trade line from your credit report like it never happened. So that actually improves your score because that negative thing is now gone. A paid in full letter can also improve your score, but as Mose mentioned before, it may not be instantaneous. It may take time for it to cycle through that you've handled these older bills. What other questions do you guys have before we move on to down payment and reserves? Shantae, is there anyone
Keep
else?
monitoring. Nope. It looks like we're good right now. I'll keep monitoring it if we have anything else come up.
Okay, perfect. So we're going to go ahead and move into down payment and reserves. And Mo, let's just do this one together. So
Okay.
Mo and I decided that we needed to put this in caps with exclamation points. Y'all can't use cash. Cash is not king when it comes to buying a home.
Period, point blank.
The money in the mattress, the money in the shoebox, the money in under your drawer, any of that, your secret stash, none of that money can be used to purchase a home. Your money, if you have money sitting at home and you want to purchase a home, you need to go put that money in the bank. Every single dollar for transactions are traced. And this is traced for a reason. It is traced to make sure that the money is coming from a legal source. It's traced because, we're trying to make sure that you're not funding terrorism. I know it sounds crazy, but as Mo said, guess what? All of these are regulations that are created by others that we just have to apply to. So we want to make sure you're clear. If you've got money sitting at home, other than being a robbery risk, please go put your money in the bank. Okay? Because we are going to need to track and source all funds that come into the transaction. I'll let you cover Venmo and Cash App, Mo.
Yes, Lisa's right. Remember, these loans are either federally backed loans, okay, or given because the federal government made the program. They made the banking system. They do not acknowledge any of the foolishness with having cash, lump sums of cash at home and coffee cans in the freezer, any of those things. So also, the federal government did not come up with Venmo, Cash App, things of that nature, okay? Because they're not institutions that regulate how you put money in, okay? So if somebody transfers you money from Cash App, that money came from them. I can't use that money for you to be able to buy a house because it came from somebody else. If you happen to run a business, say you are a hairstylist or a barber or something of that nature, and your clients pay you by Cash App, you're just going to have to keep track of that and then make sure those deposits go into the bank as you get them. Okay. You can't transfer back and forth between people. The government, when we look at how much money you have for down payment or to just keep in your bank to show you've saved and been responsible, they're looking at money only you have and you earned, basically. Let's use the word earned because it needs to come from your job. It can't come from mom, sent you money from Cash App because she paid you for something you bought at the store. We can't use that. So we want to make sure that you get your money in the bank and it's seasoned, meaning it's been sitting there for a couple of months at least because you earned it and it got there. So as you get ready to transition into being able to purchase, you have to stop doing certain activities just to make everything line up according to these guidelines that are set forth, okay? That's our word of the day, guidelines, because we have to follow them. Again, those are the things that we can't waive no matter how much we love you and want you and your family to have a home. They're going to look at those things, okay?
Okay. You can use down payment assistance programs, and we'll do another session on those, but there are plenty of them out here. You can receive gift funds. So you can actually give gift funds or receive gift funds from a family member. We actually have a really, really great question from Stacy that says, can you use a settlement to pay part of your down payment, your home? Yes, you absolutely can, because we can track where that money came from. So you can actually use, like if you were in a car accident, you got a huge settlement and you want to say, okay, home ownership is my dream, you can use a portion of that money and absolutely buy a home because we know where the money came from. Now we do have another question, and I believe this is going to be from Rochelle. And this is back on credit. And it says, do you ask for the deletion letter right before you pay your last payment? Can they decline giving you a deletion letter? So 2 different questions. And the answer is you should negotiate your deletion letter before you make a payment. Because once you've paid them, you have no power. But just because you can't get a deletion letter doesn't mean you shouldn't pay the debt. And the difference between, and yes, they absolutely can decline giving you a deletion letter because according to the Fair Credit Reporting Act, they're supposed to report the account the way you actually paid it. So a deletion letter is a courtesy, not a right. Tom added in here, monies from friends and family can be used as long as they're accompanied by a gift letter. Yes, Tom, that is correct. Depending on the loan type, in some cases, they not only have to give you the gift letter, but they also have to give you a bank statement if it's a federal loan. Because again, we need to make sure that you didn't funnel that money, like you didn't give them the cash that you had in your coffee can, and then they turned around and gave you a gift. Does that make sense? Yes? Okay, perfect. All righty, so Mo, you want to take over and talking about, we have a question about friends and family. Friends are a little bit harder. Typically, they want to see an extensive relationship. You've got to document the depth of the friendship, and sometimes that can be a lot more complicated to get accepted on an FHA loan and a conventional loan. They're really looking for your family. And I got a question from Shantae that says, so it doesn't look like a loan. I'm not really sure what that means. Okay.
Well, typically one of the reasons is they don't want to use a friend because you could have done a loan and somehow they think that family will give you free money and friends will loan it to you, but it might be actually the opposite.
Correct. So, Cassandra, yeah, so friends are a little bit harder to do, and I'm not really sure. I have some friends that are closer to me than many family members. I could get money from a friend before I could get money from some of my family members. I'm like the richest person in the family in my mind. But stop laughing at me, Mo. That's my t-shirt on my way to Mexico. Don't kidnap me.
Right.
This is one. Don't kidnap me.
Right, exactly.
Okay, so we got a great question from Cassandra. Okay, we're gonna talk about this, guys, and we're gonna wrap up. But Cassandra, thank you for bringing this up. When we ask you for a bank statement, we need the whole bank statement. What does that mean? That means don't black out your account number. Don't black out when you were out, in the casino. We need the whole bank statement, the credits and the debits, because we want to verify the activity and the flow and outcome of your assets. So I have somebody who gave me pay stubs and she decided I didn't need the bottom half. Mo got somebody the other day who gave him bank statements, and what did they do, Mo?
Blacked out items, took the account number off. You're coming to me again, asking me if, again, 250,000, we say it, and we're looking at houses in Vegas and we're like, oh, it's only 250,000. That's $250,000. The largest debt that you may have. If I look at your credit report and you've never shown history of being able to repay it before, that is the largest amount of money you're ever going to ask for. You get to not black your stuff out. You get to show me everything, because I will tell you, if you send it over, I'm going to say, do over, please. Because there's no way that somebody at the company is going to look at this and say, yeah, we'll give them a loan, because they're hiding things. We don't know what you're hiding, right? Could be an account number, could be something else. You're taking off parts of your pay stub. Nope, you get to show everything because you want the money. Right. So unfortunately, it can be uncomfortable. Like we said, we like this when you get a home loan, because we're getting all of this information from you to go ahead and make a decision and as well meet guidelines. So yes, we want to see it.
We want to go back to what we told you, which is none of this is personal. I mean, Mo just got this fantastic award from the Scotsman for the volume of loans that she closes, that she and her team closes. I mean, we do this for a living. We are licensed. This is how we support our families.
Mhm.
We're honestly not that interested in how much money you have in your account. We are honestly only interested in you winning and getting a home. So you have to treat us that way.
And that's what we're telling you. We are literally telling you how to document everything so you can be successful. You know, it's kind of the inside scoop. This is what it takes. Now let's align your lives to match what it takes. I understand if you get cash. I understand if you're moving money. There's no time like now to start living on the page with the government because you want them to give you money, right? So we're asking you to conform only to meet the requirements. After you get your home, and you may not, if you're like, hey, I only want one, I don't want investment properties after that, you can go live on the wild side. After we're done, I'm gonna cut you loose. You good. Once you get your keys, you know, go live wild.
Okay, we got a question. You are so funny. We got a question from Lori. What if you are on disability? Whether you're on disability or not, Lori, if you qualify for a home, we cannot discriminate against you because you're on disability.
Yep.
Mo, why don't you go ahead and do a quick thing on reserves and what they are? And then I'll come back. Wynette, I see your question. We're gonna have Mosaic cover reserves. Then
Okay.
and the last slide.
Reserves, remember, when we're talking about money, you need money for down payment in most cases. Like I said, we'll circle back on a different one. So stay tuned for more stuff on down payment assistance and gifts and things like that that help you get this money. But you're going to have your down payment. In most cases, you'll have to have closing cost as well, okay? Which is just the cost to pay your taxes, pay the people that it takes to pay in conjunction with buying. And reserves are the third item. What it shows is after you give the money for your down payment and closing costs, do you have some money left? We need money left, right? Because life happens. You need groceries, you need things like that. They want to look at you and know that, say you have a blowout on the highway on your tire, it's not going to make you not be able to pay your mortgage, right? Life does happen. People are off work sick, miss a day of work. How much money do you have left in the bank after you do your down payment, after you pay your closing costs? Reserves can be your 401k that you started with your employer. They can be an IRA. They can simply just be a savings account that you put aside for emergencies. Those are all things that are reserves because it's money that you have left to be able to use in case life happens. Because most people, you're going to keep your house, right? If life happens, you would reach into that savings to be able to pay that payment, which again shows that responsibility and that you have a backup plan to the plan of paying the mortgage every month, one payment at a time.
So we've got a question from Wynette. So Mo, you want to go ahead? Does a short sale affect your loan approval from over 10 years ago?
From over 10 years ago, Wynette, actually, the guidelines on VA, FHA, and conventional say that your wait period would be anywhere from 2 to 7 years. So if you've established credit again and you make payments on time, they're not going to hold that instance against you to get a loan now. And typically, in regards to credit, your history will show on your credit report, but that might be something you want to order your credit report and kind of get acclimated and get familiar with what it shows. Because you get it for free, you guys can look at your account history. The score is secondary, but look at your history. See what people are saying about you. So they're representing what you truly did with your accounts. Maybe it's not on there because it's been greater than 7 years. I know we had a downturn in a housing downturn here in town, between 2006 and 2010. If it happened between that time, we may not even see evidence of it on your credit report because it's been more than 10 years. So I recommend getting your credit report and taking a look and seeing if it would even be an issue. But if it's greater than 7 years, no, we will ask when taking an application as well.
We've got another question. Can you use a retirement account to get down payment? You can. You can actually, depending on the terms of your retirement account, typically they do allow for you to purchase your property, an owner-occupied property. You could basically borrow the money from yourself and pay yourself back at a lower interest rate. So you absolutely can use your retirement account for your down payment. So we're going to go ahead and wrap up. We're right at the 11:30 mark. Here's what Mo and I wanted to communicate. I'll take the first couple, you take the last couple. Number one, everybody can do this. If this is what you want to do, you can do it, and you've got people that want to help you do it. But you've got to prepare and you've got to put in the work. What that means is you may not be ready today because of the way you lived 2 years ago, but that doesn't mean that we can't work and get you ready for tomorrow. Sometimes it's not always right now. It might be a little later, but the key is to get you ready. One of the things that we can talk about is it's so worth it. Children do so much better when they come from the stability of a home. And this is a study that shows regardless of your income, your ethnicity, social, economical background, children do better when they have a home. So, Mo, we've got a question. Why don't you go ahead and take this? I'm a bit lost in the process. Need to know what to do next. Is there someone who can help me with the process and the steps? So Mo, you want to take this?
Yeah, absolutely. Shantae Patton she's going to post in the chat some of the resources we're talking about, so you have a little bit of a reference to go back to. So check out the chat. If you can put it in your notes in your phone or scratch it down, we want you to go online and check these out. You can get housing counseling, for starters, to get a personal assessment of where you're at in the process, so it speaks to you directly, because we are giving more of a broad overview. So take a look at it at the homeownership.makehomespossible.org. And then that way you can get the counseling. They can assess where you're at, talk to you specifically about your credit, and give you a personal step-by-step plan. That way you don't have to wonder where you're at on this range of things that we're talking about. Okay.
So Mo, is there anything else you want to, we're going to go ahead and Mo, you want to give some final words, and then Shantae wants to go ahead and close out. Okay.
I just agree with Lisa. Everybody can get home ownership. It provides generational wealth. Yeah. It gives you the opportunity to purchase. And even if you purchase, keep an open mind. Price points in town will vary depending on where you want to live. It's a great opportunity for multiple generations within one family to perhaps purchase together. I know a lot of people will tell me, I don't want to live with my mom. I live with mine. I love her. But again, if it makes it overall more affordable for you, and then gives the family something that can be an investment later, it could be awesome for the family. And again, you can build wealth over time. Again, we're not talking about quick fix. You buy it today and 2 months from now it's worth X. We're talking over time. Mom buys a house and maybe passes it down to her children. Everybody have a place to live. Or even if you sell it many, many years down the road, you make enough money to take care of the family. So it's a beautiful thing to have home ownership. And that's about it. And I know we're going to turn this over to Miss Shantae Patton to get everything closed out.
All right. So throw in the chat if this was the best thing you did this morning. So what we want you to know is this is just a broad education. Okay. What you need is to go to makehomespossible.org. Sign up for housing counseling. That is your first step, right? If you haven't signed up, that's where you need to go. When you sign up with a housing counselor, you will either get myself or Jeremy or someone Word with NID, or you'll get someone from Nevada Partners or Neighborhood Housing Services of Southern Nevada. It's a round robin. You could get any of us. But the key is we assess your credit, your finances, and your plan and time frame. Once we do that, we will then set up an action plan, whether that is a credit action plan or whatever it is that you need. We will walk you through that process. Once we get you to the point where you are mortgage ready, then we will pass you on and give you to a lender. We will give you a choice of lenders, but we will pass you on there. And then they will walk you through that process, but we will be there holding your hand the whole time. So your first step is housing counseling, right? And you sign up for that at makehomespossible.org. You will get a HUD approved counseling agency, and they will be there to walk you through the process. Now, this is not the first time and only time you will see us. If you have been sticking around since February, you know that we are continuing on with the process. Next week, we are going to talk about the due diligence period. And that is basically how to choose the right real estate agent, how to assemble your team, because on your team, it's not just your agent, it's not just your lender, it's your agent, your lender, your escrow company, your home inspector, the home warranty company. It takes a team and a village to get you home ownership. And that's what we're here to do. So first step, housing counselor. You do not have to have everything figured out. That's what housing counseling is for. So I think I saw someone say, you're really close to getting the counseling. That's what you need to do first. Send us your documents. We will send you a list of what documents you need, and then you send it to us. We will assess where you are. You might be, which is similar to a lot of the people who have signed up. You're already there. You just didn't even realize you were there. So we've already sent probably 10 or 12 people from our counseling session straight to mortgages because they're already there. They just didn't realize it, or they were so close, they're a couple months away, right? But there are some people who you might be 2 or 3 years away, and that's perfectly okay too, because home ownership is there for you. It's just a matter of getting you out there. So I want to thank our panelists, Ms. Lisa Foster and Ms. Mosaic Gatling. They are the lone whisperers. I've told you guys that before. It's because they are, all right? So we are here for you. Go to the website. Let's get you started. Lisa Foster and Mosaic Gatling are two of our preferred lenders that we typically will send over. We know that you want people who you have a connection with, who you like and trust, who maybe look like you, whatever that looks like for you, we have someone for you. So we want to thank you so much. You should receive information about our next class, which will be next week. And let's get you to homeownership. And then quickly, Lisa talked about equity. So here's what you can do with equity. I have owned a home. Every 2 years, I purchased a home since I was 21. But I got divorced about 4 years ago, and I found myself back into the renting position, which is very devastating for a real estate agent, for someone who's always owned. But here's what I can tell you. I knew for sure that having 3 kids and coming off of a divorce, I needed stability for my children. There was no other way for me to do it. I had to give them something stable, and home ownership gives that to you. So I purchased a home March of 2019 for $285 over just west or just south of Ann Road. And in my bougie mind, I was like, I started off at Craig and Alexander. I'm not going back, because in my mind, I'm like, I'm not going to live anywhere that is south of the 215. And then I had to have a real coming to Jesus with myself, because being a single mother, my money did not look like it belonged on the north side of 215. So I had to have a coming to Jesus with myself and understand what was first priority, which was getting my kids a home. So I did. I bought a house on Ann in Clayton. Lisa did my loan. I was a crazy buyer, right? But again, I buy a house every 2 years because, don't co-sign on that, Lisa. I buy a house every 2 years because I'm not where I want to be, but I have to play the game of Monopoly. I can't be on the sidelines paying somebody else's mortgage. There's nowhere for you to go but make somebody else rich. Pay their kids' colleges. That's the only thing you can do when you are a renter. So I got into the home that I could afford, right? I didn't have enough rooms. My mom was with me. We were sharing rooms. We did whatever we needed to do to get home ownership. I just sold that house, and I told you guys, I bought it for $285. I sold that house 2 weeks ago. I am currently in my new house, and it is very north of 215. It's 6 bedrooms. We've got full construction going on, but I had to take a smaller house to get here. But what I did do is I sold that house for $355,000, exactly 24 months later, which you know is my sweet spot, about 2 years, and I'm now in the house that I plan to stay in forever. And that's what homeownership got me, right? Because now my son will be 18 next year. I plan to buy him a condo in the same place that Mose's daughter just bought at 22. I plan to do this. I'm raising educated homeowners, right? And that's what we need to do. We have got to educate our community. That's why we are here. This is volunteer work for us, but we are here because we know if I can do it, if Mo can do it, if Lisa can do it, if Mo's daughter can do it, everybody can do it. Because right here, after all my expenses, I walked away with $70,000. There was no other way for me to be able to do that as a single mother than that opportunity right there. And that is the opportunity that we are committed to giving to every single one of you who wants to do the work. Okay? So makehomespossible.org is where you will go, sign up for counseling. If you if you are not already with a counseling agency, that's where you want to go. If you are with a counseling agency already, reach out to your counselor. Let's go to the next steps. Yes, NID Counseling is my counseling agency with myself and my husband. I think somebody in here said that they've met with Jeremy. Yes, go back to Jeremy and he will take you to the next level. Okay, but you can use any of the counseling agencies. They are all partners in makehomespossible.org. So enjoy your Saturday. You made the best decision today. I know it was a little early. I was rolling out of bed too. Had to take my bonnet off and everything, but it's worth it. Okay, so we will see you again next week. Reach out to us, find us. We are here for you. And we've got the dream team, as you can see. So please be safe and we will see you soon. We will get you home ownership. We are committed. 2 years, 2 months, 5 years, we're here for you. Take care, everyone. If you have final questions, post it in there. We will stick around for a couple minutes and we will make ourselves available for you. So